Hello folks. Alright, we are going to cover the need for a trading plan. If you're new to trading and you do not have a trading plan, um, it's hopefully my goal as an end result in this presentation to communicate the need for one. If you already started trading and you've been having difficulties and you don't have a trading plan, I could pretty much guarantee if you just put some work into formulating a very clear, concise trading plan, your results would be dramatically different. Because basically having no plan equals emotional driven results. Okay, you're not going to have any understanding what to do. You're going to be reacting more than you are anticipating. And that's the stark difference between a professional trader because they do have a detailed, organized trading plan. It's well written. It's by their trading desk. It's memorized. It's reviewed continuously. And by having such, they have an objective end result. And it really is the DNA of a successful trader. So having a trading plan is at the top of your list as far as being a consistently profitable trader. All right, the majority of your time, what do you do as a trader, and where is it most spent in terms of time? Well, first you got to understand that you have to manage your time wisely. Okay, no one's going to manage it for you, so it's important that you understand that the countless hours that you spend in analysis without having a clear objective or premise to it is actually counterproductive. Okay, you feel like you're doing the right thing by spending a lot of time staring at the chart, but unless you have an understanding of exactly what it is you're looking for, you're just wasting your time. You need to spend quality time with the macroeconomic analysis and higher time frame support and resistance levels. I can't stress this enough because most new traders come into the marketplace and they spend too far time in the 5 and 15-minute charts and maybe even 1-minute charts, hoping to see some kind of mysterious neon sign saying buy me or sell me. Nothing significant occurs without first leaving telltale signs on a long-term basis. That means if there's a significant price move, I guarantee you, if you look at the higher time frame charts, and I'm referring to the monthly, weekly, daily, 4-hour, and no less than a 1-hour chart, those time frames are going to have a clue as to what was the catalyst for that move prior to it actually unfolding. Follow the interest rates. This is where the majority of your time is going to be spent. You need to get a feel for what interest rates are trying to do. Are they moving higher? Are they moving lower? Keeping track of the overnight lending rate with the banks per country is absolutely significant information and insight you need as a consistent trader. Okay, what's the least important process in trading? Well, don't focus on the money, number one. And unfortunately, we all get into this business for a number of things, okay, but the top of the list should be to make money. But while you're trading, your focus should not be on the money. Don't focus on the amount of money that you hope to make. There's no guarantee you're going to make it on every trade, so there's no real point in hoping. You just trade the process, trade your plan, and the end result should, if you have a well-grounded, well-formulated trading plan, money will deposit into your account. Do not worry about losses. Okay, you're going to have losing trades. If you accept that going in, you won't be demoralized from it. Okay, every good trader, whether they're professional or not, they have losing streaks. Do not worry about missed trades. I'm going to tell you right now, I probably miss more winning trades every single week than more than most of you realize. I don't take a whole lot of trades. I like to cherry pick. I like to take things that are really set up. And if you have that mindset going in, much like expecting losses, it's very comforting to know that you're not feeling rushed. And that's a very important characteristic of a professional trader. We aren't rushed to get into the marketplace. We react slowly when trying to make money, and we react fast and quickly when we're trying to preserve our money. That's a very significant paradigm shift that you're going to need if you don't already have that mindset going in. The least important process in trading is the entry signals, and that probably shocked you right there, but it really is least in terms of significance. If you don't have a macro understanding of what's going on in the marketplace and the higher time frame directional bias, chances are you're probably going to be wrong more times than you're right. So it's my goal to really try to drive you to looking at the weekly, the monthly, the daily and the 4-hour charts. And if you're going to go a little less than 4 hour, don't go below 1 hour, but spend most of your time on the weekly and daily. Those charts are going to be the most in significance because that's where the banking levels are determined. Premise and sound basis is paramount. That means you have to have an understanding of what it is that you're doing. You're not just staring blindly at charts, because that's not going to get you anywhere. I guarantee you, unless you have a specific pattern, a motive that you use to get into a particular trade, and you hunt that, whether you're back testing or walking forward with it, unless you have that understanding of what it is specifically that you're looking for, you're just basically spinning your wheels, and it's my advice not to do that. Keep the focus on the plan and work the trading edge that your method exploits. Alright, the general overview. Alright, trading plans are basically taking all the pieces of the puzzle that equate to successful trading and bringing those pieces together. Those pieces could be fundamental data, technicals, intermarket analysis. All these things go together in terms of building a trading plan. Impeccable risk control is the first component to any successful trading plan. Flawless equity management, which is closely tied to risk control, is essential to every successful trading plan. You can have all the bells and whistles on your trade monitor, but it means nothing unless you control your money and the risk involved in all your trades. Fundamentals at any measure can always assist a trader in trade plan development. Intermarket analysis is key to a well-balanced trading plan. Understanding how all the asset classes tie together and hinge upon the movement of the interest rate markets, that is crucial for your long-term success and longevity in trading. Technical analysis and a comprehensive approach to sound tools and concepts is the framework to exercising a trading plan. If you don't have a concise list of specific tools that you use for specific times and reasons, you're going to be floating in and out with different oscillators. You're going to be using different tools. Understand what tools you're going to have and stick to those, and understand what it is that those specific tools do, and try not to use them for any other reason except for those purposes only. Executing a top-down analysis with all the above components will deliver optimal results while controlling risk, which is the number one reason why we as traders last as long as we do in this business. We control risk. So all the pieces together, it begins and ends with the control of risk. The paradigm shift. Alright guys, you are not the only predator in the marketplace. I know sometimes when we get these trading plans and trading tools, and this is the first time you've ever probably looked at organized structure of how to apply analysis to the marketplace, and you feel kind of like a big shot. And that's normal. That's kind of cool, I know. But do not overestimate the importance of knowing there's other people out there that want your money too. Whether you go in confident or you develop confidence later on, understand overconfidence is actually counterproductive. Overconfidence is actually an invitation for ego, which also allows the input of emotions, and that's not what you want in your trading. Never assume your well-designed trading plan won't hit a losing streak. I'm assuring you that it will. There's no one out there that is immune to it. You're going to have a losing streak, okay? Always reflect on your wins as a victory and your losses as a learning opportunity. All the learning opportunities that I've experienced in my trading have actually produced greater growth in my development as a trader. So losses are actually a beneficial thing. It will take preparation in advance to weather periods of inevitable drawdown. Journal your results, both good and bad. It's important that you go back to that journal because in periods of drawdown and strings of losses, it will help remind you that these are temporary events and that you do eventually trade out of them if you control risk and reduce the overall exposure as you continue to take losses. Do not overdrive your trading plan or attempt to trade outside its intended purpose. Do not turn a position trade, okay, into multiple different time frame trades. Okay, if your analysis suggests it's a position trade, trade it like that. Okay. Every great trader has one thing in common, and it's the respect and understanding that the risk will always outweigh the reward unless it is properly managed. It's not about the profits. It's controlling risk. Pack small, play big. 2% risk or less. Is it really enough? I probably get this question emailed to me more than any other. When you get into trading, guys, you probably fantasize about going to places like this, and you think you need to risk 20, 15, 10% of your account to get there. And I can assure you, I've been to places like this, and I've done it with 2% risk or many times with less than that. And it's amazing if you just understand the power of compound interest. You don't need a whole lot of risk exposure to build this wealth. The question will always be in the developing trader's mind, how can I make a fortune with so little risk? And hopefully by the end of this presentation, you'll see that you don't really need a whole lot of risk. You just need time and consistency. Proficient, consistent traders focus on the reality that their trading will not be perfect. We are not going in with the mindset expecting our trades to be perfect. Okay, we don't even need high accuracy. Okay, but you do need consistently following a trading plan. That's paramount. You have to continuously do that. You can make all the money you will ever need risking 2%, and many times even less than that per trade. Wealth is built with time, not excessive risk exposure. Keeping realistic goals in focus. Alright guys, you've seen all of the internet gurus, and you probably thought I was one like that as well, that promised riches real quick. You're going to get 1,000 pips every month. Guys, look, don't take the bait. Okay, that is meant for you to lose. Okay, do not buy into that mindset. Your goal is to steadily build your account with little drawdown as humanly possible. Your trading is not hinged on the premise you must hit home run profits every trade or even weekly. There's a lot of times I'll have a losing week. There's many times I'll have a losing day and then come back from that and be able to recoup it. But I'm not always hitting win, 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 and you're not going to either. Your career should be built on a low yet sufficient baseline target based on percent return or pips per month or week. Trading with risk controlled and profiting a net gain of 25 pips per week should be a new trader's goal. After consistently harvesting 25 pips per week, graduate to targeting 50 pips. After 50 pips per week is achieved, aim for 75 pips, and eventually move beyond that as your experience and tolerance for risk increases. All right, let's look at a case study here. We're going to look at a trading model that more or less targets and shoots a goal for 25 pips for the week, and we're looking at possibly making 6% return for the month, and we're risking 2% per trade, and 30 pip stops are used, and the monthly goal only equates to 90 pips for the entire month. Now, if you look at these numbers, okay, this is a spreadsheet, so there's going to be a little bit of a rounding issue, but 23 pips, okay, per week, roughly, we'll just call it 25 pips. That would equate to 6% return per month. If you start with $2,500 in 1 year, your account goes to over $5,000, which is more than doubling. After 2 years, it goes to $10,122. Okay, so you can see essentially you're doubling your money every single year. You're only risking 2%, and you're only looking for 25 pips per week. Now notice over here we have daily column. Okay, this is more or less to stimulate the idea that if you trade on a daily basis and you scalp, I don't really teach traders to go in and try to scalp 5 pips, but just for the sake of argument, we're going to look at, every day. If you scalped 5 pips, that would give you your 25 pips for the week. Obviously, if you're trading the best days of the week, which were Tuesday, Wednesday, and Thursday, regardless of what pair you trade, 8 pips per day, 3 times a week, would give you your goal for the week, and obviously 11 should be rounded up to like 12. Twice a week would give you your weekly pip haul. So you can see over time, your money is growing steadily, and while it's not a whole lot of money, you got to look at what you're starting with and what you're really aiming for. Okay, and I think 25 pips per week if you're a brand new trader is an absolutely wonderful goal to start with. Okay, look at another case study. This is 50 pips per week. Okay, and we're going to be targeting 10% per month, starting with the same account, $2,500. Now this time we're going to exercise the risk exposure of 1.5%. 30 pips per stop, and the monthly goal in terms of pips is 200 pips, and the weekly goal is 50 pips per week. And if you trade every day, scalping, 10 pips per day equates to 50 pips. And 3 times, Tuesday, Wednesday, and Thursday, looking for 17 pips per day, or 2 times for the week at 25 pips per trade. The first year, your account would move to $7,846, and then in the second year, it would be at $24,624. Not bad, and you're not really hitting home runs yet, guys, are you? It's only 50 pips. Okay, look at a case study where we're looking for 75 pips per week. Now I can tell you, you can build a career on this. Okay, 75 pips is absolutely astonishing if you use it the right way. 10% per month, risking only 1% per trade, using a 30 pip stop loss. The goal, 300 pips, 75 pips per week. If you day trade every single day, 15 pips would be your goal. 25 if you're trading 3 times per week, and 38 pips twice a week would equate to your goal. And in 1 year, your $2,500 would essentially grow to $7,846, and again $24,624. Modular thinking, steady progress. Now, small consistency can still surprise you. It takes an exponential mindset. Little things over a period of time equals big results. Build in your trading plan flexibility. You're not always going to see it on the timeline that you want. You might have a weekly goal that may require shorter-term day trades or scalps to achieve. Do not force yourself into hunting or believing you need to make your goals daily and or weekly. Your weekly goals might fall short a week or two, but still might be met in the course of the same month. It may just average out, guys. Your monthly goal might average out over the quarter or over the entire year. Don't be so rigid and allow the market to pay you when and how it will. Your goals might fall short of your forecast and hopes. However, do not be disappointed if this occurs. You will still be heading in the right direction, and that's really what matters. Success without home runs. Is it possible? Well, let's look at this. This is kind of lofty, I admit, but this is what could happen. 20% per month. I know it's rather impressive. I know it's a number that many fantasize about. We're going to be risking 2% per trade maximum. And now we have an understanding of what we use in our trading plan, and we have some consistency. We understand how to use a lower time frame, so we can use now 20 pip stop losses. The monthly goal is 200 pips. Still, in terms of many expectations of traders, that's very, very modest. Weekly pip goal, 50 pips. And if you break that down, it could be done over a course of every day at 10 pips, 3 times a week at 17 pips, and 25 times 2 per week. $2,500 in 1 year grows to $22,290, and in 2 years it grows to $198,000, and in 34 months it grows to what everyone fantasizes about in trading, the $1 million mark. keep something, pay yourself. You have to learn to be methodical about taking first profit, guys. No one's going to pay you. Your broker's not going to take first profit for you. They're not going to scale out some of your position and make sure you get some profit out of a winning trade. It's your responsibility. So before taking any trade, it's crucial for you to know at what level you will take first profit and then start to reduce or remove risk altogether. Limiting risk after taking half of your original position off will remove emotional and psychological pressures you may feel while the position is open. If you take first profit, that will absolutely remove all of the rush for you to be able to close the trade, because how many times have you been in a trade, even in a demo account if you guys are new, and you see a profit and you just want to close it out because you just want to see it in your account as registering as a profit? Okay, well, when you take some off and you split your position in half, take some of it off, move your stop to break even, or reduce it to half of what your original profit was, that's a wonderful position to be in, because now, no matter what, you either make half of your first position's profit potential, in other words, first profit, or you stop out at even and you collect your first, first profit, and that was it. Taking first profit at a predetermined level will assist in building confidence and removes the sting of the trade losing should it reverse on you and stop you at a break even. How many times you had a winning trade and then go against you and now become a losing trade? Okay, I know what that's like. I'm not immune to that. I experienced that. The greatest thing you can do is learn to take profits. Take first profit and scale out. Continuing our theme, success without home runs. Now let's take a look at an example. Let's assume for a moment we are a trader that now uses two positions, okay, to enter on a trade. In other words, we take a maximum of 2% risk and we split it in half. The first portion of our trade, we take first profit at 30 pips. We're going to be risking 20 pips. So we're already risking 1.5 to 1 reward to risk. Okay, so we're making a little bit more than what we're risking for the initial first profit. And if we just did that alone in the second portion of our trade, we move to break even and it stops out every single time we trade for the entire year, our account would still double. Okay, risking 1%, it would equate to 6%. So that's still good. But now let's look what happens if we allow the second portion of our trade to run. What happens if the second portion captures the average daily range? Now the average daily range, for this sake of argument, we're just going to use is 100 pips. Now that would equate to, if you just did this once per week, okay, now don't look at the daily, the 3 times per week or twice a week numbers, we'll block that out here. But the weekly number, that 100, that's going to more or less equate to one solid trade for the week where you nail down one average daily range or collect 100 pips, in other words, in terms of a intraday trade. That would equate to 20%. Now think, 20% plus 6%. What are you making? Well, we'll get to that in a moment. But if we are able to do this, our money on 1% risk grows exponentially. Now, taking both of those examples together and assuming ideal scenarios at the end where both are profitable, that would equate to about 26% return. Your $2,500 would grow to $40,000 in 1 year and $640,000 in 2 years. Notice that you're really not even risking more than 320 average per pip. Alright guys, interest rates. That is the market's driving force, okay? If you never learned about interest rates, you're going to learn a little bit about it in this presentation. But what makes the markets go around, whether it be stocks, commodities, Forex, it's all interest rates. You need to get to know the interest rate market, okay, because that will be the key to you unlocking the mine. The entire global markets are interconnected and they spin on the gyrations in the interest rate market. Each country we trade currencies with has their own interest rates, and thus these rates influence the demand or disenchantment with its own currency. The market will always seek yield, and the higher the yield, the bigger the demand on average. There are several types of interest rates that traders can track and utilize to determine a trade idea. Understanding how they trade and the yields will make long-term trends easier to determine. Interest rate spreads and differentials. Alright guys, you need to track the country's overnight lending rates. Okay, it's one of the core principles to having long-term trend analysis. And if you just Google any country and look for historical data, you can get that. Keep a spreadsheet, and you can do a whole lot with that information. It's not my goal to do that here. You can find sources on the internet to actually do these for you. But the currency markets, they more or less trend on a long-term basis based on interest rates. And understanding which country has higher interest rates and which have lower rates can be a differential play or a carry trade. Now, not only can your trade profit by the directional bias that you're trading, but it also could be paid interest on top of that. If the country sees lower interest rates, this will weaken the base currency. On the contrary, if the rates are increasing, this will prop up the country's currency. $1 Million Futures Insights. Yes, seasonal tendencies. Now, some of you folks have already been introduced to this graph. This is the British pound seasonal tendency. This is a chart that I've had held dear to me for many years, since 1995. I got this from Larry Williams' course, and it was among other seasonal tendencies, but because I've grown to trade the British pound more than any other pair, this seasonal tendency chart is kind of like, because it gives you like a macro roadmap of what should transpire. Now, one of the most impressive concepts you can learn is the nature of seasonal tendencies in the marketplace. The commodity market is one such market that has a very cyclical seasonal tendencies that have an uncanny ability to forecast major price swings. Now, I have used seasonal tendencies for nearly 20 years, and they still amaze me. One such seasonal tendency is the British pound to make a major low in February to March, June, September, October, and December, and major highs in April to May. This is also seen in stocks as well. Let's look at the comparison of the British pound, and since we've already learned that the interest rate market is what more or less pushes the markets all around, we're going to look at the U.S. Treasuries. Yes, it does have a seasonal tendency. Now, I want to draw your attention to the fact that usually in April and May, if you look at the British pound chart on the left, you can see that there's a red line and a blue line. Okay, and what that is it's measuring the bullish years and the bearish years together to get a composite index. And the blue line is a 25-year historical data, and the red line is a 15-year historical data. So you can see overall, basically, the seasonal tendency is pretty solid. It usually makes a rally of some kind late February, early March, and trades up into the April-May time period, where it makes a significant high and then trades down into the June time frame. Well, if the bonds are inverse, okay, in other words, as currencies go down, the bond market or the futures market will go up. And while the bonds go up, the yield is inverted. So the yield would be going down while the bond goes up. And for instance, let's look at the April May time period on the bond, and you can see that it has seasonal tendency to rally. That would indicate that interest rates would be going down. Okay, now if interest rates are going down, that would drive what? Currencies lower. There won't be any demand. So what will they be doing? It'll be a flight to quality. That will rally the dollar. Okay, and that would be essentially a risk-off scenario. Now look at January and February. Okay, in the bond market, we see that the bonds are sliding down into that April-May time period. That means that interest rates would be increasing. Now, if interest rates are increasing, that's going to have demand for foreign currency, and it'll be a risk-on scenario. The dollar index will be falling at that time period. Okay, look at January, February time period, and you can see where in the 15-year basis it was making lows, and even in the 25-year basis it was making lows where it did rally up. And essentially around the March time period it got in sync and made its low, and then it'll trade up into that spring time period, making a high. So study these charts, and you can see that there's a huge advantage of having insight like this, because it can put you on track to finding a long-term trend and just waiting for interest rates to get in sync with this. COT and commercial trends. Tracking the smart money. Okay guys, you've probably seen this a few times in some of my other tutorials, but mainly you want to be looking at higher time frame charts, and you want to spend some time analyzing the net positions of the large commercial traders. You want to be looking at the trend of where their net positions are moving. Are they continuously moving higher, lower, overall bearish or bullish? In other words, are they swinging bullish above the baseline zero line, okay, during uptrends, or are they doing that during downtrends? Okay, in other words, you want to be looking at the higher time frame weekly chart and determine if the price is going higher, and if it is, you want to be waiting for the commercials to be net long or extremely lightening up on their net short positions, because that would equate to a bullish scenario. The trend on the weekly chart and the swings from net long to net short are very easy to spot and determine the long to intermediate term trends or direction. Looking for trades in this trend or directional bias will further increase your odds of capturing trades with large institutional sponsorship behind the moves. Trading the news. Alright, I basically look at trading the news or news releases as volatility injections. Okay, I don't fear news, but I certainly respect it. There are certain reports and events that I more or less will step outside of and won't trade. But one of the most difficult ways to trade the markets is to try to trade the news releases themselves. The internet is littered with so-called robots or programs designed to quickly give you trading profits on the knee-jerk reactions to the news. To me, this is pure and simple gambling. We can never know for sure what the numbers will be in the reports, and to guess is just ridiculous. However, we can wait for the release and watch the reaction, and many times a signal will form shortly after the release, many times counter direction to the intended news hawks. Use news releases for injections in volatility and fuel trade ideas based on price action. Key market moving indicators. Key economic releases. Okay, we're going to be looking at the US market, the UK market, and the German market. Okay, we're going to start with the UK. The British pound. Okay, the rate decision, retail sales, consumer prices, claimant count, GDP, and industrial production. Those are reports that I have on my calendar, times when they're going to come out, and I will absolutely be aware of these, and I will be more or less looking for trades to either be propelled in the direction that I've been prior to the report, or I'll be looking for a signal to generate shortly after one of these reports are released. All right, the U.S. dollar, we're going to look at the North American market. Federal Reserve rates, retail sales, consumer and producer prices, non-farm payroll. I avoid that. I do not touch it. Gross domestic product, GDP, trade balance, consumer confidence reports, and service and manufacturing, ISM. You want to note these as well because all of your crosses with the dollar will be impacted by this as well. Okay, the German market. We're going to look at the euros. Okay, rate decision, German IFO, German unemployment, German consumer prices, German GDP, and manufacturing and services sector, PMI. You want to have these on your calendar what time they're going to be released, and be aware of these because these absolutely will move the market considerably. All right, plan for news impact. You have to have an awareness of your economic calendar, folks. Now, there are a few resources that you can use to determine when high impact news will release and hit the market. Number one, obviously, babypips.com's calendar, forexfactory.com calendar, and you can actually Google Econoday calendars. You can find some at Bloomberg and a few other resources, but they have a very good format. I like that. They're very user-friendly. And for more information on this topic, and if you have any more interest on interest rates, I would recommend that Chris Lorry's Inside the Banks webinar. I purchased this a number of years ago, and I was very impressed with his presentation on the banking level in terms of interest rates and how they move and propel the marketplace. So if this doesn't more or less get to the understanding that you're looking for, I would counsel you to do a little investment in your career. And it's not much money at all, but it absolutely is a wonderful resource. He does a really good job in that webinar. You can reach Chris Lorry at chrislorry.com, and you can get his webinar from his website. He's absolutely the only one that I recommend any folks buy material from. I have everything but his Aussie yen course, and I just don't trade yen crosses. Otherwise, I probably would have bought that as well. He does a really good job of teaching. He's very interested in your success, and that separates him, as far as my concern, from all the other folks out there. So, kudos to him. Alright guys, 30-year treasuries and T-notes. Okay, now some of my best concepts are found in my early days as a futures trader, and the bond market is a big market, and it provides so much insight and leading information. Now, I don't trade bonds anymore, but I absolutely monitor the futures on a daily basis. This market can tell you everything you need to know in any market asset class if you understand it. The scope of the bond market is not the objective here, but we will use it to discover some rather impressive techniques to ferret out some blockbuster trades. 10-year treasury notes. Okay, much like the 30-year treasury bond, I used these early on in my career as a futures trader, and there's a little caveat to understanding the bond market. Whenever you see the price chart on the futures, when they rally up, they will have inverse relationship. In other words, as the price data goes higher, the yield will actually be going down. So you have to have that in your mind. Now, since I trade the cable and the fiber exclusively, I trade tracking the German 10-year bond as well. The 5-year treasury note, much like the 10-year and 30-year, and when the price runs up on the contract, price on the futures market, the yield will be basically decreasing or dropping, and obviously if the chart would be dropping on the futures, that would mean the yield would be increasing as well. And much like the 10-year, I also track the 5-year German bond as well. And 2-year Treasury note, much like the 5-year and 10-year, I track that on a German basis as well. And by having an understanding of all three of those, we can find some pretty neat things we're going to learn about here shortly. Obviously, it goes without saying, the US dollar index. I like dailyfx.com if you go to their NetDania charting. Now, do not go to netdania.com. Okay, it's very important. Go to dailyfx.com and use the NetDania charting. It's free. Okay, and just open up a US dollar index chart, and it'll give you, what I like to see in terms of a US dollar index.